Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. I had put forward for some time now the idea that the key feature here over the last few months had been the late April to date descending wedge pattern. The latest iteration of this pattern had been an evolution from an original sideways triangle into a descending wedge pattern, then, as I said last week, maybe into something else. Now, I am conservative by nature in my work with patterns, and that it takes me a while to accept a new pattern, and also a while to disassociate myself from one that I have adopted. This time, though, the idea of the sideways triangle was good, and initially also the descending wedge pattern also. But it has become clear, especially when looking at the London sugar contract in contrast, that the descending wedge pattern did not hold water. Hence, after quite a lot of consideration, I have retired this idea and instead taken inspiration from the London sugar contract and drawn a early June to date possible descending expanding wedge pattern. That is the main feature here. And that's highlighted in dark blue on my daily chart, and it's currently between 1790 to 2478. It's quite large. I'm still not overly fond of this pattern, as it has, how should I put it, certain limitations. The main one at the moment is the upper trend line, currently 2478. I'm not sure if I should not finesse it to roughly where the short medium moving average is, currently at 2450. The latest events within this pattern had been the indecisive spinning top that was also a bearish arami, and even possibly a shooting star pattern, type 1 bearish, made 2 Mondays ago that halted at the combination of the 38.2% absolute Fibonacci line at 2488 and the then declining short medium moving average, currently at 2449. It's popped up again. Now, prices then turned back down, spending most of the next 2 weeks sitting upon the top of a congestion zone between 2372 and 24 even. That's made up from the 50% Fibonacci line of the March to April move at 2372, the July 2012 high at 24 even, and the nearby rising medium moving average, currently at 2415. This really lasted only until last Friday, when prices closed below the congestion zone. And today we have tried lower. Looking at where we are now, we have below 3 supports that halted, or let's say influenced, the halting of the decline in late June, and are still relevant now. The first was something I had been rattling on about for months. It was the interesting neckline, currently at 2303, of the August to November 2021 complex triple top, which I've highlighted in bright red on my daily chart. In the early part of 2023, this had acted as an attractor for the market, and I think in late June, this was the first application of the brakes on the move lower back then. Secondly was the combination of the lesser Fibonacci line at 2235 and the adjacent high from back in February at 2236. This is denoted by a thicker consolidated blue horizontal line. This was the main breaking action on that original move lower in late June, as we only had the one close below it before turning back up. The third was something I've already mentioned, that's the rising long moving average, currently at 2220. This was not originally tested back then, but its mere presence nearby, I am sure, influenced the market to halt its decline and turn higher. So where does that leave us now? Well, last week I reluctantly gave 2 ideas, one of which I immediately shot down myself. The second idea was to regard the action since the peak in late June as part of a possible bear flag action. This was dependent on the market carrying further lower, below June's low, which still seems unlikely at this time, and I'll retire this idea, for now at least. I also spoke last week, and I quote, "There is the opportunity for the action since May to make an out of position reverse head and shoulders pattern, but that is even more remote than the 2 previously mentioned," end of quote. Overall, the one thing I suspect we may see is that the market visiting once again the bright red trend line, red neckline I should say, on my daily chart, and that's currently at 2303. ICE Europe, white sugar in London. This contract and its patterns have been quite influential in not only deciding what has and is happening here now, but also what has happened in New York sugar. So, I've been discussing here at length some of the big patterns that have showed themselves in recent times. In late spring and going into summer, we had the domed house and three peaks. It's not the greatest example of such a pattern, but it was good enough. The drop in late June tied in with this idea, but it also opened up the opportunity for another pattern. A mid-May to date descending expanding wedge pattern, currently 515.20 to 703 even. It is a large pattern, and I've outlined it in dark blue for ease of reference. The latest efforts have seen attempts since the middle of July to push up against the upper trend line. Meanwhile, below we have a significant and important neckline, currently at 622.80, of the August to December 2021 complex head and shoulders top, which is highlighted in bright red on my daily chart. Plus, just below that, the rising long moving average, currently at 613.5. These two turned the market higher back at the end of June. Now the question now is, will prices proceed back down to that bright red neckline and the long moving average? And what will they do should they get down there? As yet, I'm unsure as to whether we'll see a move lower, but the longer the upper trend line caps the market, the greater the chance of a pullback lower. However, the alternative of a strong break higher, well, that then gives us opportunities and targets topside for the descending expanding wedge pattern. There is one final pattern that I would like to discuss, something I noticed after last week's commentary, and another obtuse pattern as well. You see, we could also look at the action since the end of May as a possible, and I really hesitate in saying this, a possible reverse head and shoulders pattern type. The reason I hesitate is simple enough. This pattern would be in the wrong place. If you have a bottom pattern of any sort, common sense dictates you actually have it at or near the bottom, something this pattern does not have this year. However, the more I look at it, the more it looked like it might work. Yet, I cannot get away from looking to label it as such. That is why I've added the postscript type onto the end. As to whether it will be a reverse head and shoulders bottom or a continuation pattern, well, that's too early as yet to tell. Sugar white premium spread. We are over halfway into 2023 and this chart is still one of the busiest and most colourful charts I have. Many things are still going on, all at the same time. Okay, so I've previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitch wall from 2019 to 2021, which is highlighted in dark blue on my weekly chart. This is still very valid. The market at the moment in between the lower time below, currently at 107.5, and the middle time above, currently at 181.75. I have said this so many times, and I will repeat it again today. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. Next, we have an ascending expanding wedge pattern, highlighted in bright red in trend lines and above the current market. This was formed between mid-April to late November last year, and currently 195.5 to right off the top of my weekly chart. To me it was, and still is, not the best looking of such wedge patterns, but it is also still out there. And despite being treated or tested as recently as mid-April this year, and it comes all the possibilities such a pattern invokes. Now, the most recent activity had been the market's actions around all the moving averages, notably the long moving average, currently at 131.25, and the medium moving average, currently at 138 even. Early activity pushed prices down through the two 50% Fibonacci lines at 128 3/4 and 131.5, and the June 2020 higher to 134 even. But then most recently, we have moved back up over all of them and up through the congestion between 152.5, 152 3/4 to 155, and 162 3/4 to 164 3/4, and all the way up to some 2011 base congestion between 173 3/4 to 175 even before pulling back down. The notable feature of last week was the break up and over the neckline, currently at 154 even, of the June 2021 to May 2022 reverse head and shoulders bottom, which is highlighted in pink on my daily chart. Now, 8 weeks ago, I drew both a bullish Andrews and a bullish shift pitchfork for the August 21 to February 2023 action. And I have chosen yet again not to highlight either of them, as they neither add nor subtract from the current situation. Although the lower tine of the bullish Andrews pitchfork, currently at 129.5, has shown some promise as a potential support, and we are not too far away from the middle tine above, currently 179 3/4, of the untested bullish shift pitchfork. Okay, so the final point I'd like to discuss is a big picture item, one I'd mentioned 8 weeks ago. It was to look at the whole of the 2022 to date action as a possible huge lopsided diamond pattern. Back then, I just lodged that idea in my own and your mind, as there are elements of such a pattern here. But there seemed to be enough going on elsewhere that I didn't wish to unnecessarily add to the mess of lines. However, 7 weeks ago, I decided to go ahead and draw this potential diamond top pattern here, which you can see highlighted in dark green on my daily chart. As you can see, the prices have broken out to the bottom of this pattern, and for a while it looked like the market was going to follow through lower for the diamond pattern, long enough for me to set up some potential targets below of a primary target X in the 47.5 zone, with a secondary much harder to reach target X1. Well, that would be down below 0. I'll retire these targets after this commentary, as even the primary run, well, that would require a huge move lower, and all we have had since mid-June is a seeming false break lower. Yet I would like to do the following, and that is finesse this pattern a little further. Okay, so what you see right now looked like the final version of this lopsided diamond pattern. However, if I were to extend the pattern a little further, like so, then perhaps this lopsided diamond pattern is not wholly dead. I'm not a great one for too much optimization, however, I will let it happen this time, just to see if it works. We should know next week if it does, I hope. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.